Hello, fellow Rebel Capitals. Hope you're well. We are back with my good buddy, Ben Bray. Ben, what on earth do you do? Can you explain it in 30 seconds for my audience?
I guess you could say that I'm a volatility trader in essence, but at deep down, I'm a value investor. I just like to
Really?
find, yeah, yeah, value investor. I just buy cheap volatility, but I buy cheap stocks too, which, think about a small cap stock is just cheap volatility in some way. But yeah, I'm a kind of a utility man of a hedge fund guy where I'll do small cap equities on the long side and I
Okay.
will trade volatility and I will trade interest rates. So, but I'm what you might call an old school discretionary macro trader, I guess, with a bent towards value.
Okay. That's a mouthful. So what if you and your gal go out to dinner and you meet someone that you've never met? They say, "Oh, Ben, what do you do?" What do you say?
I say I'm a hedge fund manager, and then I'm dabbling in the world of financial media. Because I'm also I have a podcast, and I'm partner at Wall Street Beats, and so I've enjoyed this part of it actually a lot. This used to not be part of it. I never did social media until the last like year and a half, 2 years,
Yeah.
and like so this has actually been fun getting to meet a lot of guys like you and Hugh and a bunch of guys along the way. But yeah, I don't know. I guess trader. You could say trader. Like you never you want to know who you're talking to. How deep do you want that conversation to
Yeah.
go? Right?
Yeah, exactly. So tell us about the Facebook trade. You were texting me the other day, and I think the last time we talked, we were discussing the AI bubble, if I wasn't mistaken. And you had a short position in Facebook that you closed out. So you can kind of, if you could tell us what your macro view was there, what your thesis was, and then why you closed out the trade.
All right, so that's what it was interesting because I was thinking back to it because I was going to write. I'd done all this analysis and I was going to write a report and then I never put it out and then it happened. So it's like, well, you can't put it out after the fact, right?
Mhm.
And that sometimes happens when you have to actually trade, like when you're not just focused on content, you have to actually run a book and stuff. That sometimes you just forget to like put it out there in the world. So
Yeah.
I have a Substack and like I don't write nearly enough because I have other things going on. Yeah, I think it's good to focus on it. We talked in September, right? And we had said, hey, look, there's a thing going on here where Oracle and Meta and CoreWeave and basically we're gonna all they're all fun and then the rest of the hyperscalers, we're all spending all this money to basically line Jensen's pockets. Not That's not why they were doing it, obviously, but that was what the outcome was. And the question was, why are they doing all these circular joint venture things, which we had seen in the .com, right? And it's well, maybe because they know their forecast for cash. So looking out, so if you pull up the models on them and you look out, you see, oh, well, in the next 12 months, free cash flow or capex is 550 billion or 525 billion amongst CoreWeave, Oracle, the four hyperscalers. And so, that money's going to Nvidia, which is going to have 150 billion of free cash flow next 12 months. And so then he was like, oh, well, Meta's actually going to be losing cash like after their buybacks and their dividends and their reality labs and the capex. So I was like, they're going to have to hit the debt market, and the market's not going to like that. And
Mm.
that's what happened. They did. Kudos to Mike Green because when we were at Hugh's event, he kind of like laid this out to me. He's like, "Hey, you should take a look at Meta," and I was like, "All right." And then I did, and then when you looked under the hood and looked at the math, you're like, "Hey, it's not the end of the world," because their top line was fine. It was
Yeah.
more of that. If you remember when they actually changed the name to Meta, it was because, and then the stock got dunked on pretty hard. It was because he was spending too much, and the market was like, "Hey, like, this isn't what we signed up for," and so it gets re-rated. Um, and so Oracle announces that deal with OpenAI, and it's since then it's down 45%, and its credit default swaps have gone from 40 basis points to like 130. Meta goes from 750, 760 to I don't know what the low was. I think it was 580 or 585 or something like that. Um, and I kind of like thought the covering it was okay because I shorted like CoreWeave as well at 140, and now it's at 70. I don't know. It's hard. The trade becomes harder after the initial move.
Yeah, right.
And I know myself, and again, to go back to the value thing, like I'm good at shorting things like at the asymmetric point or buying things at the buy, like, at that point. The middle's harder, like, because you might be right, but can you handle a short squeeze? So I just become a little more nimble, like in the
Mm.
middle, which doesn't necessarily mean it's the right strategy at all. It's just my own personal style. I think some guys can sit there and ride it, but we just had a really good re-rating of the capex recipients of the speculative areas of the market. Would you agree with that?
Yeah, I would. I just to clarify for the audience, though, before we move on, I want to just kind of unpack that a little bit. So, with your Facebook thesis, you thought, okay, well, they've got all this capex spend, and initially they're taking it out of free cash flow, but net or what they have in the bank, let's just say the assets on the balance sheet, the retained earnings, as we used to say as an
Yeah,
entrepreneur. I'm not sure what you guys
yeah.
call it in your world. But now your point is they've got all this capex spend just to keep up with the Joneses, and they're going to have to start issuing debt in order to make to pay Jensen. And that's when you thought rubber meets the road. Is that correct?
It's a little more nuanced than that in the sense that everybody kind of knew that, right? But I think what it was is that the funding side of it, right? So if you're gonna make two assumptions, right? A assumption is the top line was gonna be fine. I wasn't making an assumption that any of their business's top line was gonna change in the near term.
Right.
And the second was that their spending was gonna be that they had a spending policy, like a capital policy. You know what I mean? Like, here's what our capex spend is gonna be. Here's what it's gonna be next year. And so it was kind of like this spending was going to grow in 2026, but is going to grow at a decelerating rate. And then once I personally think the return on investment on these LM models is shaky and
Okay.
uncertain at best. And so that what would happen is that as doubt crept in on that, and then people realized they did the math, and then they'd hit the debt market, like that there would be re-rating in the equity and credit of the weakest players. And so the market's traded very rationally, right? Like within the Meg 7, Google's traded well. The market's kind of assuming that they're doing well. I know everybody's excited about the Gemini 3. And, Google has their own TPUs instead of Jensen's GPUs that they can use.
Right.
But Google also hit the debt market. Meta and CoreWeave's the weakest. It's down 60% from its high. Oracle is probably down 45% from its high. Both Oracle and CoreWeave have gotten pretty drilled in the credit markets. Meta now has done a $30 billion actual bond deal, and their CDS just started trading. So now you can actually trade their credit spread if you
Mm,
want to in the market, and its equity's gone down 20% or so. So you've
I see.
seen, but Meta has the ability to turn the spigots off. And my thesis is they'll be those three guys will be your first candidates for like the capex to cut. And then if
But
you
that
think
but that
about
cap but that capex, to be clear, is Jensen's revenue.
yeah, exactly. And then but more important than Jensen, because Jensen has a fantastic little spot right now and he prints cash,
Right.
um, is the outer realm of that, the riskier areas of it. The guys who are the second derivative of the infrastructure spend. So some of the power names and some of, for example, uranium miners have gotten drilled here. Like they're down 25% since just October 28th
Right.
or whatever. So it's like the power thesis, the infrastructure guys like a Vertiv or something, all those things that were right riding this huge capex spend. Now it gets into question because two things. A, we're questioning the model, and without getting too deep into it, an LLM has a problem because it's a low information density model. So you like basically have hit the the foundational limits of the model. So you have to keep spending more in actual capital to scale it. and it scales linearly at this point, which is the problem. So how much capital do we want to spend of society? Water and actual money, etc. And then the second thing would be, and what's the revenue model? That's the other real issue. And
Yeah,
then the
right.
second thing would be, how are we funding it? And so, the way I did it was free cash flow, which is just, cash from operations minus capex, and then basically then cut out your dividends and your stock buybacks, because they can always cut those, but I don't think the stock reacts well when you cut those. Plus, they pay their employees a lot of stock-based comp, and
Mhm.
so it becomes dilutive if you don't buy back the stock. So those are not they're not fixed costs, but they're semi-fixed, I guess you could
Right.
say.
Yeah. Yeah.
And so then after that, Meta was having 15, 13, depending on your numbers, $1 billion like hole to fill. Google was kind of like at 2 or 3 billion, and CoreWeave was deep negative, Oracle's deep negative, and they're going to be hitting the debt markets, and everything's just kind of responded. And so now we're saying, okay, well, we've had this first re-rating, things can keep going for sure, but like the question is who will fund it and what is the right multiple? Because like Meta, so to finally answer your question, I guess, sorry for the long story. Meta's like 15 or 16 times earnings right now, so
Mhm.
it's not that expensive for the business. So you just have to be confident that they're going to keep doing what they're doing. Because if they even hint like, oh, maybe we'll slow it a little bit, the better short than Meta would be some of this other stuff that is reliant on that 2027 capex numbers not
Yeah,
getting
that's
brought
really the
down.
tipping point. Once one of the big players say, "Whoa, time out here. Let's just pump the brakes a little." That's usually the tipping point where
Yeah, 100%. That's exactly what like you're looking for as the catalyst for this. And so I think what we just saw was the first stages of it. And to be fair, I mean, if we go back to Q1, we had people getting a little worried about it then.
Mhm.
There was no funding pressures. See, the funding part of it makes it more real. Because let's just like remember, Amazon, Google, and Meta issued between the three of them like $65 billion in debt. And then you add in Oracle, there's another 30 billion. Then you add in the off balance sheet ones. Now we're talking about hundreds of billions of new credit. So it's putting pressure. It's not like the end of the world or anything. It's just showing you the way forward without cash flow, like without these things starting to really add cash flow, right?
Yeah, that's the key. Is it's great. It's the future for sure, but where does the profit come from? Like, and another thing that I think is interesting and very, very important is the difference between the internet model, let's say, and AI. And the big, big, big difference here is that your margins on, let's just say, Microsoft Office, once you get to a certain point, are basically 100%. But so you've got these fixed costs, and then everything that you sell, all the revenue above and beyond that, is pretty much profit. Where with AI, it's different from a standpoint of all your costs are fluctuating. You got fixed costs, but then every single query that is made costs you the exact same amount of money, right? At this point in time, before it gets more efficient. So let's just say every single query costs you 5 cents. Okay, so it doesn't matter whether you have 5 billion queries or 100,000, you're paying 5 cents a pop. Where if you're selling Microsoft Office, then once you get to a point, you're again you don't really have a cost to deliver that software. And I think that's something that people really miss when they think about the ability for these hyperscalers to scale and actually make money.
Yeah, I think that the hyperscalers, like, I've read somewhere that like if you go on Sora, you familiar with Sora, the
Yeah,
OpenAI video thing,
yeah, I've
that
used
like,
it occasionally.
okay, have you noticed the prevalence of cat videos on there? Um,
No, I don't go to the homepage.
but I made a joke that was like it's like $5 a video roughly. So I
Yeah.
was like, what are we doing? We're just making $5 cat videos all day, like like that's not a sustainable thing.
Yeah.
Hundreds of millions of people out there just, and so I think the question is like, if you think about 1999, who went bankrupt? Who do you remember who the guys who all went bankrupt were?
No, no, I was alive, obviously. But I
Oh,
was
it
just
was the
getting,
telecoms. It was the telecoms that went
yeah,
bankrupt,
I
right?
wasn't paying attention to this stuff at all.
Okay, so in the 99 2000, it was the telecoms who went bankrupt. Nortel, like Lucent, like all these guys. And they were the ones who were doing all this capex spending. They built the foundation, the cable companies. They built the foundation of what the internet lies on, right? All that fiber that was laid out. The guys who ended up becoming the hyperscale, or not the hyperscale, the big seven, they were all software players. And Microsoft was around back then, so was Amazon. But Amazon was a different beast. It wasn't a cloud company then. It was just a online bookseller, an online retailer. But the software guys now have become the telecoms as well. I think that's like the
Mhm.
key insight here is like they kind of rode the back of these. I like to call him John Henry. John Henry, who laid the mythical character who laid the railroads.
Mm-mm.
Um, if you look it up, it's stupid. The point is, the guys who laid the railroads in the early days,
Yeah,
most all of them went bankrupt.
yeah,
But
yeah,
obviously, the railroads were super important to society. You built out this transportation network, but the initial pioneers all kind of got, like, the capital providers kind of got wiped out because there's just so much capital, and the returns were in the future. And
right.
so in the 99 part, it was the telecoms. Now, these guys are kind of the telecoms spending on this. And then the
Mm,
other thing that we haven't talked about, and I this is why I kind of wish I would have wrote this report. One of the things that, when you spend time looking at the math, is the what is the useful life of this capex.
right,
Now
right.
I know Michael Burry came out, the Michael Burry of Scion from Big Short fame came out and started talking about this, and I thought it was fairly well known, but I guess they brought it to light. And basically, these chips, how long do they last for? If they're roughly like half the capex or whatever, and 1 year, 2 years, but then, the argument was, well, we're using it 6 years later. And it kind of comes back to what we said in the last call, me and you, which is like, hey, our computers still work, but does that mean we're operating at peak, like, performance? Like,
Yeah, yeah. Like
George and
using an
Ben,
iPhone from 2012.
yeah,
It's like
yeah,
it
it
works,
could
but kind
technically
of not.
work. Yeah, 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 like that concept. And then you think about it versus the railroads or versus the fiber. Like, the railroads, there's still railroads around, like, and look, they might have laid some more ties over the years, but like that was a 50-year asset. The fiber that they laid, the phone lines that they laid, because the phones were another big innovation cycle 100 years ago or whatever. They last for a long time. The question is, like, how long does this capex last? Because if it's only 4 or 5 years, that means that you're going to have a huge depreciation. Like, let's say 5 years on two, or 4 years on $2 trillion, which is the numbers of the pie in the sky. That's 500 billion a year in depreciation. So, like, that's not actual economic value. That's just the equivalent of heating your home with your furniture. Does that make sense?
It does. As you're saying that, I'm thinking, okay, everyone understands your premise. I think most of the people watching this video would probably agree with most of it. But in my mind, I'm thinking, okay, how does this impact the S&P 500? Because we've got this weighted index that's heavily skewed toward basically the AI trade. So if the AI trade starts to unravel, how does that impact the S&P 500? And then more macro, how does that impact the United States economy? Because I'm someone that believes that the US economy is totally propped up by asset prices, the S&P 500 and the housing market. So if the AI trade is effectively the S&P 500 and the AI trade goes away, S&P 500 goes down, what does that do to aggregate demand in the overall economy?
So one of the things that I just kind of talked about and tweeted out is we've seen, as this deleveraging started, you've seen healthcare do really well, and you've seen staples do decent, and you've seen bonds kind of have a little bit of a bid,
Yep.
and so it doesn't necessarily mean the end of the world for the S&P. Like the S&P since it's down like 5% or 6% off, although it's up a little bit today. So 4 to 5. I mean, that's not the crazy correction so far, right? Whereas like what the speculative stuff is down 20 to 50%, right? So I think underneath, and that's actually what happened during the dot com. That's what happened in the Q4 of 18. That's what happened in, basically 20 Q4 22. Like basically when you are, uh, whenever you have like a deleveraging, there's a rotation that goes on. The
Hmm.
question will be, is the sustainability of it? Like,
Okay.
is it just people covering their shorts and that they funded all these longs with, and we're just kind of clearing out some of the speculation, or is it that this will roll over? Because I think the spending's still there, right? They just did the debt deal, and so it's basically a situation where do you believe in 2027 capex? If not, then these things will kind of come in. Money probably rolls over into some different areas. And then I think what will happen is you'll just have to have the Fed keep cutting rates and then, basically try and get the housing market and the average guy, taking rates down could help and try and get the credit machine working again. If they are unable to do that, then yes, I think it will keep kind of going down to the right or sideways at best. And you'll go into more defensive stuffs, and the more speculative stuff that doesn't really trade on, reality will kind of converge to reality, if you will.
Yeah, with interest rates and the Fed, I have tried to go back to mid 80s because that's when they really started to target the interest rate with Greenspan. Prior to Greenspan, they really weren't doing that at all. Volcker, I remember reading, he had a 4% spread, a 4% spread on rates that he was like okay with it. I'm talking about Fed funds. And so I just can't see a time, and maybe I'm wrong, but I can't see a time when interest rates really controlled the economy. I can only see a time when interest rates were a reflection of the economy, meaning
Well,
that it's really tough to have the Fed drop interest rates and say, well, that's going to be a boom for the economy, because the fact that they're dropping interest rates tells you that the economy is deteriorating and the
correct.
fundamentals are deteriorating, and therefore kind of be careful what you wish for. And I'm not talking about you, I'm talking about when you hear this on CNBC and they're saying, oh well, this is fantastic for the housing market because the Fed is going to drop rates. We don't know if that drops mortgages because that's on the 10-year, and the Fed definitely doesn't control the 10-year. But B, it's okay. Well, what else does it mean? Because if you have the lower rates, that's great. But what does that tell you about the labor market? And if the labor market is suffering, even with the lower rates, does that mean that housing prices will go up? Maybe, maybe not.
Yeah, so to unpack that, I agree with you completely that people have it wrong that rates down is good thing and that rates up's a bad thing. It's
Right.
actually the opposite. There's a
Yeah.
paper, Dr. Richard Wagner, who wrote the Princes of the Yen, which is a great book I'd recommend people see, and they actually have a YouTube video of it. He wrote a paper showing high rates, strong economy, low rates, bad economy, even though that's
Richard
kind of
Richard
the
wrote Richard wrote that paper?
yeah.
Oh,
He wrote a
I
paper.
didn't know that. Yeah, he's a good friend of mine. I don't know if I ever told you, but he came out to my event that I had in Houston. Really good dude. But anyway.
Yeah, yeah, I follow him. He follows me on Twitter. I don't know him very well, but I've read his stuff. And I think he's very sharp. And he,
Yeah.
this is a guy who identified what was going to happen in the Japan bubble, right?
Yep.
And made his name off that call, more or less. And anyway, so I believe in that, which is what you're saying. And but what you're trying to do is take the price of money closer to where the puck is, if we want to use the hockey term, right?
Okay. Yep. Yep.
Like the puck, the game's over here, puck's here. We got to move the puck back over to where the game is, and we don't actually know. We're just hoping, And I know hope's not a strategy, but they don't really have anything else they can do.
Mhm.
And but ultimately, what it will be is trying to take that price down with the idea to get the leverage machine working again in the
Yeah.
private sector,
Yep.
right? So both in the market, and remember the two things: real economy, which is lending channel, and then the mortgages, other credit, consumer, industrial loans, etc. But then also in the securities markets, like securities markets require a lot of leverage as well. And so to some extent, like there's a two-pronged approach to that. Credit spreads have hung in there, okay, they're elevated, but like if you think about '08, for example, when they take rates down from 5.25, 5.5, whatever it was in the fall of '07, and then next thing you know, by a year later, we're at zero, a year later and change, I guess. You have to remember that the spreads on mortgages and the spreads on credit were blowing out. So the private sector cost of money was exploding. And so they try to take the base rate down to offset the private sector. So there's two pieces to the price of
Yeah.
money. You have the
Yeah.
government piece and you have the private sector
The
premium
premium.
piece.
Yeah.
Yeah, exactly. And they often move inversely. So as government rates are going up, credit spreads get narrower, and vice versa, obviously. And so that's when I say that is that if you're starting to see the signs of deleveraging, I'll just give an example on Friday. So Thursday afternoon, we covered some shorts, and I was like, "Hey, we're gonna go long the front month SOFR contract, which
Mhm.
is SFR Z5, with the idea because on October 28th, if we remember what happened, Jay Powell came out like a tough guy, like, "Hey, we're
Yeah.
not
Yeah.
going to cut rates in December.
Yeah.
I'm
Yeah.
the man." And then Mark's like, "Okay, well, I'll show you what we're going to do now." And in the things that had the most sensitivity to leverage, aka liquidity, had a pretty good like walloping there for 3 weeks. And on Friday morning, Williams comes out and says, "Well, we'll cut in December. We're thinking about cutting in December." And the odds of a cut went 70-80%. And then market kind of like caught a little sailwind, if you will, because Thursday was very ugly. If you think about, like, everybody thought Jensen was going to save the market, and I actually was like, real time. If you go on my Twitter, I was on the other side. I was starting to buy like short term options that morning, and I was like, this is going to fade. Watch, and it just one by one they were just fading. Like,
Mhm.
the starting the day off with SanDisk, which we were short, was red, and that was the only one. Then he started adding a few more, and the next thing you know, the whole board. Then Nvidia was red, and then people were like, "Whoa, what is this?" And so then my idea was that the market's going to force the Fed's hand to cut the way they did in Q4 '18. Do you remember that
Mhm.
when Jay Powell was a tough guy then too,
Yeah.
and
Didn't they
and
call
he
that? They
stole
had a name for
Christmas?
that. They had a name for that, didn't they? The
I always call it Jay Powell stole Christmas, but I'm sure there is another name.
it was the anyway. Keep going. Keep going.
So okay, so now we're kind of sitting around here, and it's a holiday week too. I'm not taking too much
Oh, the
like
taper
from.
tantrum. I think it was the taper tantrum.
No, that was 13. That was 13 with
Okay.
Bernanke.
Okay. I'll stop. Keep going.
Um, but basically, so we're now in the situation where I don't want to see the bubbles burst, but it's definitely not. It's the Teflon vest has been removed. There's a couple flesh wounds on the story, is maybe the best way to think of it.
Yeah.
And I think the underlying economy is not very good. I don't think that's a controversial statement, but here's where I think people are at. We had this long shutdown. And people want to know, was it just the shutdown? Was because our economic data is like we're given like September data. They're not even going to give October. I think what's going to happen is if you're a professional and you're sitting on a good year, why not you just take your ball and go home, pick it back up in the Q1 of 26? Why would you try and defend this like and mess around here? Because again, if they come out and they don't cut rates in December, it's going to be it could be pretty ugly for like
Mm.
until like they get on the plane. So again, this is the week of Thanksgiving. It's a holiday week, whatever. But I think that's kind of the plan of action that I see for like going forward is that we have the beginning stages, which we talked about on the show in September. We saw, hey, this is ridiculous. There's a real risk here. Now I think the market's aware of it. I think the market's aware that the US economy is not great, but then there's the next level of analysis has to be, was it because of the shutdown? What happens now the government's getting back open? And then with the AI thing, was it, maybe we need to bring it back some. So it's not like the train's shutting down. It's just maybe you can see it's maybe speeding down, like slowing down just a little bit, or slowing down a little bit in the future. And since equity markets are a discounting mechanism, we're going to have to take some of these things down a little bit.
What is your base case? Where do you land in that debate? How do you come to the conclusion? And do you use interest rates as a signal to come to that conclusion? And I'm not just talking about the curve. I'm talking about like SOFR rates being trading significantly higher than like Fed funds. So you've got secured lending and repo trading at a higher interest. I don't know if it has been lately, but I know for a while there it was trading a lot higher than Fed funds, which is unsecured, which for me, that signals that there's a lot more counterparty risk within the system. And that goes back to the tide going out, the cockroaches, blue owl. I'm sure you've been following that story.
Mm-hmm.
So I'm just I'm just trying to get your framework and what your position is on whether this is just all about the shutdown or there's some severe economic underlying issues. And then how do you come to that conclusion? Then we can take it from there.
Yeah, I'm on the side of that things are rolling, which I think I told you like when we were on the show before and in St. Bart's. And I think the shutdown makes it worse
Okay.
because they weren't getting paychecks out. So what happens if you don't have a paycheck? The government I think is the biggest employer in the country, and if you don't get a paycheck, then you got to dip into savings, and then you start to not trust the situation as much, and then I think also the government administration that we have has lost some uh, momentum. Like I think that they, there's infighting in the GOP. I think it's just not the same thing as that was in the spring, where it seemed to be a
Yeah.
unified,
Yeah.
and
Marjorie
so
Galvez quit, as an example.
yeah, exactly. That's just another data point. And so you question, the tariffs have been a tax. That's been my view all year. Now,
Yeah.
that's another wild card. What happens with this tariffs in the Supreme, they're saying the Supreme Court's going to rule against them. Do they refund it? Do they have new tariffs? Like, what's that?
Mm.
I'm not a legal expert, so I'm not exactly sure. But I think that that's one thing. Will this administration try to go more stimulative, as because they can see their political um, momentum again, for lack of a better word, waning, and we have the midterms next year. Um, but yeah, I think that underneath the surface, the reality is that the average person's economy isn't the rich person's economy, and the rich person's economy is contingent upon the S&P staying high,
Right.
and the S&P probably has been driven by AI, as you said earlier, the most. And so if we're starting to see cracks in that, and we're starting to see some compression in, the amplify, like Well, the most simple way to think about it is like Nasdaq divided by S&P, and like so Nasdaq divided by S&P kind of is a way to measure the internal amplification or contraction of leverage. And so in 21, obviously, and end of 20, massive expansion. 22, it comes in. 23 till now, it's gone out, and now it's starting to narrow some. And so my view is that's what's going to happen, and we'll have a chance at rates coming down, and then on the other side, similar playbook to the post.com, where if you think about like rates, so to go to your point about rates, is like the way I think about them more is that I'm thinking about them as a reflection of the market's like current mechanics and
Mhm.
thinking. So both. It's not necessarily all just thinking, because there is mechanical things to it. Like I think credit spreads are too low, and I think Fed rates are too high. So my expectation is Fed rates are going to keep coming down. Credit spreads are going to widen, maybe not widen like to 1,000 basis points, but 600 to 800 will where they kind of will top out. And then eventually, that this will kind of settle, and then we'll kind of move forward to the next phase of things. But it's difficult because the lower rates is bad for large cap stocks, and the legacy winners, and it's good for the people who have lost. Because if I used the example on my show the other day, the Palantir is like $6 or $7 billion in cash, right? So if they earn 5%, that's $350 million a year in interest income, and they have no fixed liabilities, right? So rates come down to zero. Well, that's huge gone. And by the way, I think it's like half their net income.
Mm,
But that's a totally different. I'm just using that as an easy example.
right.
So a lot of companies in the large caps that make a lot of cash, have a lot of cash, and they all termed out their liabilities in 2020, 2021. So a lot of rich people who termed out their mortgages, which is the household's biggest liability, in 2021. So rates going up is actually great for all the people with all the money and all the cash flow, right?
Mm,
Because their asset side is generating higher income while their liability side is fixed. So
right.
this is actually inflationary. The rates going up is actually inflationary. Rates going down is deflationary, and so there'll be less. Again, like we have $10 trillion in T-bills, and so if you go from paying out $500 billion a year in that to paying just 100, it's $400 billion of national income that's not there. So it's by definition deflationary, right? So that's kind of my view. My view is that things are rolling. The under the hood, though, it's just so interesting, George, because if you look at like a stock like Six Flags or Dave and Buster's or Harley Davidson or Pool, which is like a really good business that installs pools at people's homes, they're just down in the right. They're close to the liberation lows now. So
Yeah. Yeah.
you have to like not get like too like all or nothing, and look
Hmm.
like what you're looking at, because the S&P does not really reflect everything. It just kind of reflects this concentration at the top. And so if you're just only concerned about the S&P, then that's what you have to focus on, right? If you're concerned about, oh, okay, well, how do I want to invest in the future? There's stuff that's already discounting the reflective. I mean, like Target is just a no bid stock. Like the U.S. consumer is, I'm not there yet, but I'm starting to think it could be getting closer and closer to how it was in investing in energy in 2020. If you remember how terrible energy was, and no one wanted it, uninvestable. And so the U.S. consumer, a lot of those stocks, not Walmart, not Costco, although Costco's down year to date, those are reflecting a pretty ugly reality.
Hmm.
And so that's what puts more pressure on the weight of the Mag 7 and the hyperscalers and the AI trade, because that's been the only game in town, more or less.
Yeah. So let's talk about just making money. Let's set the macro stuff aside. We'll get back to that. But as far as just setting up your portfolio strategies to make money in this environment, one thing that I was in St. Bart's a couple weeks ago. I think we talked about that. And one thing that's been working really well for me, now keep in mind, I'm a complete amateur. I mean, you know that. And
Oh,
and
you're
everyone on
sharp, buddy.
everyone on my
Don't self-deprecate like
well,
that.
look, the intellect, that we'll save that for another conversation. My understanding of the monetary system, we'll save that for another conversation. But as far as just placing trades, I mean, I'm complete amateur. So anyway, but one thing that's been working really well for me this year is I think they call them pairs trades. So what I've done is I said, okay, I want to be short, like CarMax was one that I hit a complete home run on. And I said, but I don't know what's going to happen. You know, there's all these ups and downs. Is Trump going to come out and buy stocks? I mean, who knows? So I thought initially what I'll do is I'll just put on the short on CarMax and then offset it with a long on the S&P. And also, too, I thought, that'd be nice because you get the tailwind from passive, which is what Mike Green talks about all the time. Where CarMax, I don't think they're part of the S&P 500, so they're not going to have that tailwind. So anyway, I put that on. I've put on a few of these pairs trades, and they've worked really, really well. So I went out to St. Bart's, and I was telling Hugh about them, and Hugh basically told me I was an idiot. He's like, no, that's stupid. Don't do that. He's like, here's why you don't want to do it. And what was funny is he was telling me how stupid I was for putting on the pairs trade. I was specifically talking about CarMax and the S&P when I was going over this with him. And like 3 days later, like when I got back,
CarMax is down like 30% or whatever.
in like one day, yeah. And I still had the position on.
That's great.
So anyway, and my point is, what do you think of those pairs trade? Because that's kind of what you're talking about, right? Where the S&P, it can do all these things, but then the retail like Target and Chipotle or whatever, they can't catch a bid. And is that a good strategy? And then I guess my next question would become, are the CarMaxes of the world getting so low to where you might take the opposite position and you might want to go long those because now they're in the value category?
Yeah, so that's kind of what I was alluding to. So you know, long short equity as a strategy, that's what it does. Now, it doesn't do it necessarily explicitly like I'm going to pair trade it. It's like here's the stuff I think is going to do well, and I'm going to fund or short, the stuff that is either going to be flat to down. You don't always have to make money on your shorts, right? Like if you can just get stuff that's not going up or
Or that
going up
goes up less than the S&P. You
goes
win.
up a lot, or the stuff that's going up a lot, right? So think about the recent action. It's like over the summer, people funded with staples and the healthcare stocks, and they bought AI anything, you name it, whatever. All these stocks, they were great, and they're so if healthcare is just flattish or up just a little bit or down some, and these things are up, 30%, 50%, well, you can basically by shorting, you get more long, is the general
Mhm.
idea behind what you're talking about. But the problem with that strategy is ultimately is you're taking two bets, right? So it's a relative volatility bet where you can lose on both sides too, and that happens sometimes. And like that's when you see. So to go back to what happened beginning of October, is that a lot of guys in the street were getting absolutely, like the pod shop guys were getting absolutely drilled on these, speculative meme stocks, the AI, speculative stocks, the power stories, the Bloom Energies of the world. And then basically there was a whole bunch of under the surface reshuffling of how they were running their books, and then they had to hedge this stuff in order to like offset it, and it took it to levels that were absolutely asinine in late September, early October. And then we finally had that deleveraging event on October 9th. And so they were in hell in the sense that they were losing both sides. And that's sometimes where you can see like turning points for this. But as a way
Mhm.
to make money, to answer your question, like, you know, if you were to say recently, hey, I'm going to short, this is what actually I did. So just we can use my own thing as an example. Like I've been long XLV, XBI, XLP, without going too far into names and stuff, but like generally a lot of those and bonds. And
And
then
what
I
are those?
got the healthcare ETF
Okay,
and the
okay.
staples ETF. I want to keep this like higher as opposed to getting bogged down by individual names.
Yeah.
But like they have been flat to up a little bit over the last, however, a month or so. And I got pretty aggressively short all the bubble speculative stocks,
Mm.
October 16th, 15th, around there. And so like running both sides of that is in essence what you're talking about. Now it's not, you know, exactly a pair trade, because like back when I started my career, that was a popular thing guys would do. Be like, hey, I want to short UPS and long FedEx. That's
Yeah,
when I think
yeah.
of a traditional pairs trade. I think that's more along the
Okay.
lines of what people think of.
Yeah, I
But
was long Bitcoin and short I still am. But I have
yeah,
had that on for like 3 months. So that would be more of like a technical pairs trade, right?
no, that's like an arbitrage trade, right? And so I actually recommended that in March of 2024. I put a tweet out. They got like 2 million views, and I sent his stock down like 30% that day. And I had said, well, you should just do what Sailor's doing: sell MicroStrategy and buy Bitcoin. Just
Yeah.
follow what he's doing. He's telling you what to do.
Yeah. Yeah, right. Yeah, that's
But
funny.
the one thing I would tell your listeners, is that that's not without risk, because
Yeah,
even
yeah.
if you're right, which that trade's worked, um, you are short volatility. And so,
Mhm,
for
mhm.
example, if you go to, let's call it November, the fall of 24, you were getting killed on that trade because MicroStrategy is positively correlated with volatility. So its stock does well when there's volatility, which is weird because most stocks aren't like that, but also very Ponzi like, right? But then it eventually mean reverts because he issues stock at the highs because he has a premium to his Bitcoin holdings. And so
Mhm.
there's a natural governor on it. But like, just so
A
everyone
governor on the
knows,
volatility, just to be clear, right? On the volatility of the
a
individual
governor
stock.
on the expansion of the premium,
Okay.
right?
Okay.
Like if you go to Strategy's website, and they like to refer to it MNAV, so market valued NAV, like a bank, right? Like
Mhm,
I'm currently short JP Morgan, and one of the reasons why is that the price to NAV, their book value, their equity, or their tangible book value, their equity is very elevated, and
mhm.
so I might not make much money, but I might, and if I'm wrong, it's gonna sit around here. I mean, it's not gonna get away from me too much, right?
Yeah, right.
Um,
Right, right.
and
Okay.
so that's how I think about it, and that's how you have to think about Sailor. And Sailor is actually interesting because he's got this thing where they're gonna try and kick him out of the indices and call him a hold, because he
Yeah,
wants to, like,
yeah.
is he just like they're basically a hold co, and
I
then
saw that. The rule, to just for the viewers so they're following, I think it was MSCI. Is that the
mm,
determining body here? And what they're arguing is that, look, anyone that has over 50% of Bitcoin, or I think pretty much any asset on their balance sheet, they're not really a company. They're more like an ETF or something like that. So we can't really have them in our index. And if you take MicroStrategy or any company really out of the index, then they don't get those passive flows. And that could be extremely detrimental to the overall share price. And I think they come out with that announcement, or with the decision, January 15th, if I'm not mistaken, 2026.
yeah, yeah, should be interesting. I mean, I look. I think that guy definitely is got the funniest. Have you ever looked at his 25-year stock chart of MSTR?
No.
It's amazing. You should pull it up. It's like there's one little blip in the dot
Like
com.
99.
Yeah, go 99 till now, and like there's this blip during the dot com, and then he set the record for the most money lost by one person in history. At the time, he lost $6 billion in a day, and then
Uh,
and then now it's got another blip the last couple of years. And I was laughing. I said, this is like an EKG, like in a hospital.
yeah,
It's like
yeah.
it's like the perfect measure. Is like, is there a bubble going on? MicroStrategy will be ripping. 25 years tested.
Hey guys, if you're watching this video right now, you probably know the stock market, the housing market, pretty much every market is in a massive bubble right now. The Fed is totally out of control and the debts are exploding. You know this doesn't end well, but the question is, what do you do about it? Well, fortunately, I've got the answer. Now, let me be clear. If you're the average retail investor just watching CNBC and trusting the system, this definitely is not for you. But if you've been sensing there's something wrong and you're looking for clarity through all of the chaos, then Rebel Capitalist Pro is your unfair advantage. What is Rebel Capitalist Pro? It's the private investment community that I have with my good friends Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Seresna, and Jason Hartman. It includes private member-only live stream Q&As that gives you direct access to the pros I just mentioned. Also, proprietary research from Lynn Alden and Chris McIntosh, model portfolios, exclusive whiteboard videos, and best of all, the Rebel Capitalist Pro community. Rebel Capitalist Pro is basically the cheat code you need to not only protect your wealth, but to build wealth and thrive in this crazy world of asset bubbles, out of control central banks, and big government. So stop worrying about this stuff. Stop losing sleep and start investing with confidence. For more information about Rebel Capitalist Pro, we'll put a link in the description below this video. Yeah. Okay. So we got the pairs trade. Now let's go back to interest rates, Ben, because there's so much going on here. And I think there's a lot of confusion. There's a lot of things, a lot of narratives that I disagree with. But I want to get your view on this because you're the expert here. So first and foremost, let's tackle Japan. And we've got their long end that's going up a lot. And the narrative here that I disagree with is everyone's saying it's because their debt is just finally caught up with them. The debt to GDP is 225% or whatever it is. And this is the bond market just rejecting all of the government spending and the debt. There's just too much supply, not enough demand. And I really focus on the United States. So when they started pushing this narrative, I wanted to actually look at the data and the facts. And because the argument there is that debt and deficits drive interest rates and growth and inflation expectations do not. Or are there times when debt and deficit expectations matter more than growth and inflation expectations? So I actually pulled up their nominal GDP, and their nominal GDP is like 5% in Japan. And their 10-year is trading at 1.8. And I'm like, well, wait a minute here. It should actually be trading a lot higher, but not because of the debt, because their nominal GDP, because growth and inflation is a lot higher. And then I looked at another chart and I saw that their debt to GDP has actually been coming down since 2020. So I'm like, okay, you've got one chart that's inversely correlated when you look at the interest rates, and you got the other chart that's directly correlated. And by the way, their 10-year sovereign JGB started going up in Q4 of 2022. That's when it really started to go like this. And if you look at nominal GDP, it did the exact same thing at the exact same time. So my point there is I believe that even when you look at Japan, it's all about growth and inflation expectation. It has nothing to do with the size of their debt, unfortunately. But what's your view?
I tend to agree. My buddy David Dredge is out of Singapore, and he's wrote a lot about it. And he's kind of an expert, and he said he always asks, "What if it works?" Right? Because the Bank of Japan has been the clear most easing bank of all time. Right? These guys. I mean, I don't know what the percentage is, but it's really high. What they own of the ETF market, for example. Like they went down the hey, we'll just liquefy all financial assets.
Yeah, let's just go full
And
retard.
yeah, basically the macro equivalent of full retard. Yeah, and so basically, yeah, their growth has improved. Now, nominal GDP is also a function of a weakening yen. Remember, they're an export nation. But yeah, I think you have to look at the mirror that is the yen, and the other side of it is the JGB yields, and it's the same thing. It's like you're looking at the same thing. So if you track yen versus like just dollar yen versus JGB yields, they're kind of they work together. And to your point about growth, so yeah, I agree that growth is better, and they're trying to be more competitive, and it's working some. We'll see, does that they do have a lot of debt, like for at the government level, but I just don't ever think of a government like as blowing up. Like I think that's like just a mistake to think about government debt the way we think about private debt, unless you're an
Yeah.
emerging market. Like if you're an emerging market and you need access to global capital, but Japan's the top three economy in the world, and I don't think that they're gonna blow up. I think that there's price dislocations that can happen, but yeah, my view is more that it's reflective of a weak currency, and then growth has been better than expected, basically.
Yeah. If and I've tried to think about, because that's always my position. It's in I look at nominal GDP in the United States and the 10-year Treasury, and you can go all the way back to the 1950s, and it tracks like an 85% correlation. There's actually an inverse correlation with the amount of debt, deficits, debt to GDP, and interest rates in the U.S. Often an inverse correlation. So I've tried to ask myself, okay, that's the way it's been. Why has it been that way? And so mechanically, and then I say, okay, well, what market signal would I see that would make me believe that now it's different? And I think that if I saw the 10-year Treasury as an example trading like 5% higher than nominal GDP, now all of a sudden that's the market telling me, okay, the bond vigilantes are actually here, and something's going on there that isn't responding to obviously growth and inflation expectations. So the likely culprit would be the debt's just too big and the bond market's puking it up. But in order to get to that point, if nominal GDP, let's say, is at 4%, I would have to see the 10-year trading at 6, 7, 8, something like that. If nominal GDP in the US is 4%, the 10-year Treasury is trading at 4%. Again, unfortunately, there's not a problem. And I say unfortunately because I think the price is paid by the actual economy through the government spending itself. So I'm not saying there's a free lunch. There's not a free lunch, but the price is paid by the economic distortions in the economy, lowering the standard of living versus the actual bond market.
Yeah, I think that what you'd want to see if you were really worried about like the currency, for example, is you'd see it trade the way an emerging market would trade, right? Like think about Turkey or one of these countries like that, and Brazil. They constantly have the short end of the rates way higher than the long end, so it's inverted. Um, you're not going to worry about the long end is because there's going to be no long end. There's just going to be no market basically. There's not like a huge bunch of people exchanging 10-year paper in these kind of like fiscally unsound places. Like you take rates up a lot in order to make people want to hold your currency,
Mhm.
or at least tolerate holding your currency, right? And I last I checked, yen's like pretty close to zero still. It's like we're still sub one on the short end. And yeah, like you're starting to see some inflation, and that should be reflected in the long end. There's a little growth, there's a little inflation. That's it's not that crazy. Like again,
Yeah.
I just think back to Richard's paper, like rates up, good, like rates down bad.
Yeah.
Japan, well, I was at 30, it took them 30 some years to get back to the high of 1989, right? Or 1990. Like, and I know Hugh's been talking about it recently. He's like looking at it, he's like, wow, they're finally back here. I mean, if the yen, I think there's a chance the yen keeps going down against the dollar, but that doesn't mean the stock market can't do well, for
Yeah.
example. Like often, if your currency goes down some, it can be good for a stock market, especially if you're a big exporting nation the way Japan is. Japan's an interesting place to look at. Yeah, I would fade all the people who are on the like out there though saying, "Oh, this is the end. Like it's all blowing up." Like I'm on the other side with you on that one, buddy.
Now let's move back over to the United States, because there's a well, kind of a similar argument, I guess, when people are looking at the lack of liquidity in like repo SOFR rates, and they're coming to the conclusion this is all a result of a lack of bank reserves. And so, because there's not enough bank reserves, we're seeing interest rates creep up. My view is different there. My view is that it's not about bank reserves, because I think there's plenty of bank reserves, but it's more so about counterparty risk. So the example I use is, say you're a hard money lender and you have $10 million to lend, but every single person that's coming to you is not creditworthy. You don't think they're going to pay you back because you think they're too risky, or the asset they're buying is too risky. So you're going to do one of two things. A, you're not going to lend, or B, you're going to lend at a higher interest rate. And it's not because you don't have money. It's because there's too much counterparty risk. So I think it can be both. But I just don't, it can be obviously a lack of liquidity. But I think the lack of liquidity is more so, much more so, a result of increased counterparty risk versus just not enough bank reserves. What do you think?
Yeah, I don't. Again, I think the bank reserves thing is stupid. I just think that like that's not like a like that's a clearing mechanism, if you will, right? Like it's not the end of the world. Like yeah, the price of reserves in order to clear, like they systematically usually go up at the end of March, at the end like the end of the quarters and stuff, and but like I don't think that's like changing the world in any way, shape, or form. I just don't see it structured like that. That matters. I think what matters is, the amount of collateral damage that can be done in market prices. Like, I created this chart. I wish I would have sent it to you. It's from November 28th until Saturday or Friday. There was $9 trillion of total market cap lost in Bitcoin, U.S. equities, uh, uh, silver, gold from the October highs,
Mm,
basically.
okay.
And that's a lot of collateral. Like think about that, for example. Like the Fed's balance sheet is 7 trillion or something like that. Like the capital value loss just in 3 weeks exceeded the Fed's whole balance sheet.
Mm,
So
right.
like when you talk back to about Blue Owl, like yeah, there's some issues going on in private credit that are reflecting the tariffs, that are reflecting a weaker economy, that are reflecting a high cost structure. Um, and so people might not want to lend or do any of that because of those reasons, but I'm not a big subscriber to that reserves are all that important, to be honest.
And how do you explain the repo blow up in 2019? What do you think caused that?
Well, that it was quite tight then, to be fair. Like that things were quite tight, and that was essentially I don't think it was because of reserves. I think it was basically there was extreme tightness and lack of collateral.
Mm,
Like I don't see, do you see right now there being a collateral shortage? You know,
right
I
now, no,
mean,
I think that's why they're issuing so much at the front end of the curve. I don't think it has anything to do with, interest rates being too high in the 10-year. I think that Besant is looking at this and he's like, we have to provide more collateral.
yeah, I just think there was not enough collateral at that time. And I mean, look, it's funny, George, you talk about 18. Um, I was comparing this to Q4 18, and I was like, okay, they're going to try and push the Fed to cut. And then I pulled up like a chart that was like relative performance of the S&P versus the various sectors. And
Mhm.
it's interesting because tech and Nasdaq relative to S&P actually outperformed the S&P by a lot. Um, and that was mostly because if you go back and look, like those stocks were actually cheap back then. They were kind of more staple defensive-esque back then because their balance we started this conversation off by the balance sheet changes for the worst that are going on there. Well, back then they were as pristine could be,
Mhm.
right? And And so I think that, and they were cheap. Like I think that 2018 market up to 19 into COVID, there just wasn't a lot of liquidity and there wasn't a lot of collateral, and stocks were just where they were. Post whatever the CARES Act and then whatever the follow-on act was, we've put in a ton more collateral. We've raised rates. There's been just a lot more ability to leverage in the system. Now the
Mm.
question is, as we go to the other side, will we deleverage some of that? But like, I'm not in the view of what you just said of that the repo crisis was caused by reserves. I think it was just a lack of collateral and it was very tight liquidity, system and the system then. And I don't even know if I'd call it. You call it a repo blow up. I think it was an issue. I don't think it was like August of '07, for example. Like,
No, no. But if for one day, I mean, the repo rate spiked to like 10%, and the
sure, that
Fed just
happens.
completely lost control over the front end. Not that they have a lot of control over it to begin with, but you know, that was obviously an issue that could have turned into something bigger.
It did. I mean, if you think about it, it did turn into something bigger. Like people will blame the virus, but like it was very clear that the I was very bearish at that time, and
Yeah.
you could go back to your question about interest rates. The 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 forward market was pricing in cuts. Like we were definitely rolling at that point,
Hmm.
and that lack of liquidity then means it transmits. So I think I think the history books will always talk about the virus and the pandemic, and I don't really need to sit there and argue. But I think that the untold story is that that was happening irregardless, and this actually just gave them cover to create a whole bunch of new collateral in essence.
And when you mean create collateral, just so the viewers following that, you're talking about, unfortunately, government debt.
Treasuries.
Government debt, yeah, supply of treasuries. And I just want to point out to the viewers that the twos and tens did invert in August of 2019. To your point that uh, maybe things would have gotten bad, or we would have had a recession, even if it wasn't for what happened in 2020.
Yeah, I mean that was just my view, but again, the counterfactual is tough, and
Yeah, yeah.
we'll never know. But like, I think that it was very clear that the economy was rolling then, the markets were very tight, and look, just to finalize, let's just bow tie that. Things were very tight, and Jay Powell came out and he was trying to do this hiking campaign, and the markets just were like, no moss, like we do not have the liquidity to take rates this high without crushing things.
Hmm.
And if you remember, we were at what, two and a half, two and a quarter. What was the highest he got there? Do you remember? I'm
No,
trying to think. Yeah, well, anyway, and so in the Q4 of 18, when they're like, well, I'm not even thinking about not raising rates, and this is like December 16th, and then they wheelchaired that guy back out in like January 4th of 19. He's like, well, maybe we'll hold off a little bit.
yeah, yeah,
And
yeah.
then the market ripped until the summer, and then the issue started coming back up that it was, they cut in the summer, but it was like, hey, it's too tight again. And then it just kind of like, it's always, you got to remember, why are you hearing stuff? What are they telling you things for? And don't always believe the surface level story you're told. I mean, at the end of the day, the asset markets of the world, the debt market is 350 trillion if you include the offshore market, and the Fed's balance sheet is 7, right?
Right.
7. And then you have the other balance sheets, the central bank balance sheets up. Maybe we get to like 20 or something. That's a big mismatch. And then you add in the equity markets at like 150 trillion. So say 500 trillion, just liquid debt and equities. Like they need confidence to be like, you got to have people willing to extend the duration on their portfolio and make sure the leverage machine that facilitates that, the carry, right, of extend and borrow short, lend long. Like if that thing doesn't work, there's a big accordion move down,
Yeah,
right?
yeah,
And
yeah.
so that, I think that like is a way to think about what you're saying, which is reserves and the Fed. They don't matter as much as people think they do. They're really important at the
For
confidence
psychology,
game.
for psychology.
Yes,
Yeah,
yes, that's the way I would think about it. Like they're
not
extremely.
mechanically, but psychology.
And look, I'm not just speculating on that. There's many papers that have been written by the Fed themselves. This whole concept of forward guidance,
Yeah,
like,
yeah.
and honestly, Wall Street itself, independent of the Fed, think about what Wall Street does. They hire analysts to give you forward guidance. Oh, you can feel better about owning XYZ stock because here's the analyst, here's the professional analyst, like forecast for 2026, for 2027, for 2028. And,
Yeah.
there's
It's all
no
a
empirical,
psyop. It's all a psyop.
it's a confidence game,
Yeah.
basically, right? And that's why it's been a very tough time for guys like me and others, like older guys who were more serious, like fundamentally oriented guys from 2014, 15 till 2019, with the exception of that Q4 18. And I wish I'd known Mike Green back then. I would have understood this, but like that passive bid plus the corporate buyback bid, we got to a one-way market much
Mhm.
more than, guys like me are more mean revert. You asked me the first question, what do I do? I'm more of a mean reverting trader. Like I like see a trend. Okay, here, this is this, or maybe it's too low. Let's go like this. That we got into this one-way train, and like, so there wasn't as much value in being able to actually see things. The value was, I mean, if we could go back 10 years, what would you do? You just buy the cues and play pickleball for the rest of
Yeah.
the time, and make videos on YouTube and talk about it along the way.
Yeah. Right, right. Yeah, that's funny. All right, man. So last question. What do you think the Fed's gonna do in December?
Cut. But
You're gonna
if
cut.
that, yeah, I mean, I'm positioned like that way. Now, if the cut gets fully priced in, I'll take that front piece off because I'm not as like there's not the asymmetry is not there. But I think they'll cut. But like if they don't cut, so again, let's remember what you think and what's the realm of possibilities, and then
Mhm.
what's the pricing of things relative to the your possibility curve is what matters.
Yeah.
And so scenario one, which is the scenario I would say more than 50%, like more likely, is they cut. In the scenario they don't cut, you want to think about, well, what happens in that scenario,
Yeah.
right?
Yeah.
So right now, clearly with the market, like, had a nice bid because ever since Williams came out and said that, market's like, okay, whatever. And again, it's holiday week, so I don't take too much into it.
Mhm.
But if they don't cut, and then imagine they don't cut and then they're hawkish, right? So there's don't cut, hawkish, then you could see things like take another leg lower. And so
What do you think
I
rates
think
do
that
then? What do you think, like, the 2-year and the 10-year?
my guess is that the 2 year will just keep coming in, but it's the 2 years at, like, what is it today? 355, 350?
I don't know. Let me look real quick.
I'm
It's
just doing
353.
I mean, that's what I'm sorry, 353, no, the 250. I think in the beginning of the year, it really got ahead of itself. The forward curve did. Now
Mhm.
we're starting to see the forward curve price in more cuts. Like it's been really reluctant to get below where it's at right now. Um, so I think it'll be a function of this eking lower, and then the 10-year will follow it.
Mhm.
And but again, the scenario, if he cuts or he doesn't cut, I think they buy the 10-year. Like I think 10-year gets bought, so you'll see a
We get a
flattening
flattener.
if they do that. Yeah, because
Mm.
if he doesn't cut, you have to have the front eke up a little bit just to reflect that,
Yeah.
and then people will buy duration because it'll be negative for liquidity, and basically they'll move out the curve. But
Mm.
one way or another, I think that they're trying to run this tightrope dance of keeping the curve somewhat steepish, not letting duration get bought too much, but also not cutting too fast so that, remember, there's only so much left to cut, right? We're at 352 year. I mean, the SOFR, or like the 2 year contract, 1.5 year contract is basically saying rates will be 275 to three, in a year. So
Right.
you got a decent amount of cuts already priced in. That means there's only, what is it, 10, 11 more cuts that they can even do. And so, QT's done, starting, I don't know, a couple days actually, December 1st, right? And so, yeah, I think that's kind of, they're just trying to not like waste all their bullets, especially like what the S&P is near the all-time high. It's like, what are they afraid of? That's the other thing that you got to think about, is like, why are they cutting, and like, what are they protecting here? Like, do you know what I mean? Does that
I
make
think the labor
sense?
market.
How? Well, explain that to me. What do you mean by that?
Well, so if I'm trying to put myself in their position, I'm saying, okay, we've got a dual mandate, basically labor market and inflation. So right now we're looking at the labor market data, and it's terrible, and we're getting these revisions. I mean, August got revised down to a negative number, and based on my research, usually when you start getting negative non-farm payrolls outside of like a weather event or like a huge national strike with Walmart or something, that means that the economy is deteriorating quite rapidly. So, and even the headline number 119 is not a great number, although it exceeded expectations. So then you combine that with the ADP, and you're saying, okay, the labor market is getting really, really weak, and that's a concern. And based on the labor market alone, we should be cutting. But then you've got let's just call it the CPI used as a proxy, hovering around 3%. It's above their target. So that's kind of the balancing act right now. And so I think that if it wasn't for inflation, kind of staying slightly above their target, that they definitely would be cutting based on the labor market.
Yeah. So, okay, I'm with you on that. Like, I think it's like, there's, they say a dual mandate, but it's really a triple mandate, and the main mandate is keeping the markets working and taking
Yeah.
care of the banks,
Yeah.
right? And
Yeah.
so I think that mandate is more what they're focused on, and the labor. And I think inflation is just like, they're like, it is what it is. Like, yeah, I'm not convinced, again, that raising rates helps inflation. I think back to what I said about,
Mhm.
the people don't think about what do the liability and asset structures look like at any given time. Right now, everything's in reverse. In the old days, I could understand it a little better, but now I don't think it helps. I think if anything, it's just inflationary, and it just creates more K economy dynamics. So, and the final thing I'd say about this, George, is people don't talk about this fact. If you lower interest rates, it makes it easier for new entrants to get capital. Right now, you got to get through the first period where there's a shock to the system or whatever. But then you get down there, and like, cheaper capital means more supply, right? So if you're a legacy player, you're one of the winners. You don't want cheaper capital. You want like more regulations and more expensive capital, because
Mm.
you're making the cash. You get
Right.
the money on the cash, and then it's harder to have new supply
Yeah.
competition.
Use interest rates as a moat.
In sense, yes, just like they use regulations as a moat, right?
Yeah. Yeah.
And so lower rates can actually lead to deflation. And let's just think about the easiest way to think about that: copper industry, or mining, pure
Mm.
commodity business, right? Like, not like, oh, I'm getting Johnson and Johnson, or there's some brand factor. Um, Me and you, we release some land, we go drill some oil, right? Well, it's a lot easier to do that when we have better, like, capital prices, right? Independent of what the price of oil is. Well, that's the kind of deflationary when you can bring more supply on, right? And I don't hear anybody argue, like, talk about that dynamic. We always just have this blind faith to interest rates up is how you get rid of inflation, and interest rates down is inflationary, and
Mm.
miss a lot of other, like, components of it. Like, is bank
Yeah.
lending going to work? Like, where's the puck actually? Back to your point, and then, well, what if it actually works? Like in Japan, okay, like, it took how long of low interest rates? I mean, how long do they have had zero rates for?
I don't
And
know,
they
20
and they
years
got
or
a
whatever.
they got no inflation for a long time, right?
Yeah, and we couldn't do it in, post GFC, 2008 to 2020, we
Did
couldn't do it.
nothing.
And when
It
we
did
actually
nothing.
got it, it was a result of a lot. I think it was a result of supply chain disruption, supply shock, and more so a result of velocity increasing because of the government was just basically taking money from savers and giving it to spenders. And so you have velocity, then you have a little bit of a money supply increase, but I think it was more so those other components. It definitely wasn't a result of what the Fed was doing, or else we would have had big inflation or higher than 2% from 2008 to 2020.
Yeah, I would say that exactly back to what we were saying about the collateral. You printed a bunch of new collateral and some actual money supply growth. To be fair, the PPP was true like money printing, in the sense of like they guaranteed those loans to banks and then
Yeah.
they let them off the hook. So that was, and I got a PPP check from one of my businesses. Like that was real. There was actual money printing there. Okay,
Yep.
but
Yep.
but but if you look at the amount of debt supply of the Treasury, market value debt supply is up like 40 some percent, 45%. I have to check it exactly. And I would say the price level, plus or minus, is somewhere around there, roughly. Like, and so it kind of follows that. And whereas during the 2010, that period, there wasn't much in the way of big fiscal spending or anything, right? Like they're running a deficit, but it
Hmm.
wasn't like crazy. And so I think that shows that Japan and that zero rates is not going to cause some massive inflation. It's just going to be a lot less profitable for banks, is what it's going to be.
Yeah. And I would say there's also some nuance there too, Ben, when you're talking about lower interest rates increasing supply, because for the big corporations, I think it is true that lower interest rates equals kind of easy money, if you want to use that term. But I think for the broad economy, especially the mid and small size businesses and the consumer, often lower interest rates is tight money. And it goes back to Friedman, right? I mean, he had that view in the 1970s. And as an example, in 2012, that's when I retired and I started, getting into real estate investing. So I went out and purchased all these homes in Kansas City, Missouri, and these were really nice little homes, and they're all in like B and A neighborhoods. They weren't the ghetto or anything like that, and they're just kind of these like 3-bed, 2-bath, 4-bed, 2-bath, and I bought them all with cash, right? So I've got like 20 of these things, let's say, and I put renters in all of them. So every single one of them is cash flowing. I own them outright in cash, and I go to the bank and I'm like, hey, you think I could maybe just get a line of credit at like, I don't know, 40% LTV? And every single one of them gave me the finger. They told me to pound sand, and interest rates were 0%, right? And I'm like the ideal, like the perfect borrower. It's just they didn't want to touch real estate with a 10-foot pole, because back then everyone knows that real estate always goes down in price, right?
It
That
was a
was
good time to buy real estate in hindsight, buddy. That was a good one.
I did very well on that one. I did very
Yeah, I
well.
bet you did. I
I
bet
did
you
very
did.
well on that. But you see my point that for the mega corporations, it's true. In 2012, money was easy and they could create more supply. But for 95%, money was actually tight.
Yeah, and that's ultimately a different conversation of like how do you
Yeah.
open up a credit channel? And but I guess my point is that rates down doesn't necessarily mean that they're going to send the money out. But
Right.
if the price is too high, the real estate market right now, right? The 6.25-ish type of 30-year, it's much better than it was at 8.25, whatever the high was, 8.5. Um, but it's still like relative to a couple years ago when it was at 3.5 or 3.25, it's much more expensive, right? And I think that another dynamic of rates down that could create deflationary dynamic would be there, where there's a lot of people who feel stuck in their homes, right? They're
Yeah.
stuck in their mortgage, is what I should say, stuck in their mortgage. And that's why it's not surprising that the administration is trying to float this idea of portable mortgages. But like if you're stuck in your mortgage, you're basically like, well, I'm going to stay here, and I can't, like, I don't want to ratchet up to a 6.25. So you're kind of
Right.
stuck there. Whereas if we took rates down, then they're like, whatever. It just we don't have this mismatch, and then there
Yep.
would be a lot of supply that would come online,
Yep.
and then you
Yep.
could get housing prices down or flattish down, whatever. But you get turnover. Housing turnover is just abysmal. So
Yeah.
if you're a real estate broker, if you're in the couch business, if you're in the landscaping business, I mean, I mentioned pool, SE Pool, the stock, like the pool creating business has not been very good. I got my ass kicked in this James Hardy Homes, which is a building material company. Uh, it's not a great time for a lot of those. And the one thing I'd say about housing is that it's a high multiple business, like high multiplier of economic growth. And right now, it's like the actual industry is stagnant. And
Yeah.
so, I think that's why the administration talks about it a lot. I think so. I don't have all the answers on this, but I just know that the current situation, it's great for if you own 20 homes, for example, or just one, and you're paying 3.25, or you have it in cash. And it's terrible if you're a new family trying to buy a new home or start anew. So, like, I think that's the big challenge,
Yeah.
and then that will be kind of where we see what matters to get the economy going again somehow, right? Like it seems so anemic now, and there's a few areas of strength, but it's just not. It doesn't feel like it's boom times at all. I'll tell you that.
Yeah. That's for sure. Ben, how can people find out more about what you do? You said you got a Substack and a podcast. Where
Yeah,
can they go to check
I
it out?
started a new podcast. I had a podcast with my partner Nadine, and then she had some issues come up. So I have a new podcast with my buddy Rupert Mitchell out of Australia called Benny and the Squirrel, because his Substack pen name is the Blind Squirrel Macro. And
Flying squirrel. That's a good one.
and we do live shows Sunday night and Thursday night on X and Substack, and then you can find us on the YouTube at Benny and Squirrel, and then I have Substack, which is at Capital Mass Allocation, and then you can find me ranting on Twitter occasionally at Ben Bray, and then the name is Capital Mass Allocation. So reach out to me if you're interested in chatting. I like chatting with people, and always like chatting with George.
All right, buddy. Thanks a lot for your time. Can't wait to talk again.
All right, buddy.